Hello everyone, welcome to this video. Today, we will discuss the three main documents of the financial statements: balance sheet, income statement, and cash flow statement. Together, they represent the most important source of information for business owners, managers, and stakeholders. The balance sheet includes assets, liabilities, and owner's equity. Assets are resources acquired and retained by the company to generate profits. Liabilities are obligations toward other entities coming from past business events. Equity is the residual interest in the assets after deducting all the liabilities. Assets and liabilities are then classified in the balance sheet as either current or non-current, as explained in the slide. The balance sheet follows a very basic rule: the value of all assets must equal the value of all liabilities plus equity. To keep this balance, we use the double entry approach. Any transaction which impacts one account must also impact at least another account. Let's focus now on the income statement. This document measures the increase or decrease in economic value generated for shareholders. It provides a measure of the company's profitability. The cash flow statement provides information about the inflow and outflow of cash. In other words, it provides an overview of the company's liquidity. The inflow and outflow is categorized as cash from operating activities, cash from investing activities, and cash from financing activities. Let's go through an example. Imagine to incorporate your own company together with some other partners. The very first transaction we record is related to the cash received by shareholders in exchange of common stocks. This transaction will impact the balance sheet, assets, and the cash flow statement, financing activities. No impact to income statement. We utilize the T accounts to track the double entries related to our transactions. We debit $50,000 in our asset account for cash, and we credit the same amount in our equity account called paid-in capital. We also summarize the overall impact to the balance sheet and cash flow statement. We purchase in cash, land and a building. This transaction will impact assets accounts only. We credit our cash account for $40,000, this represents a decrease of our cash availability. Then, we debit land for $5,000 and buildings for $35,000. The total value of our assets does not change. We update the cash flow statement, including $40,000 in the investing section. No impact to income statement. We purchase $20,000 of goods, with the aim of reselling them for a profit. This transaction will impact our balance sheet, both assets and liabilities. No impact to cash flow, because we are not paying the invoice now. No impact to income statement. We debit $20,000 in our asset account for inventory, against accounts payable. Our total assets value went up by $20,000, compensated by an increase of liabilities for the same amount. No change in owner's equity. We sell part of the inventory, worth $5,000, for a sale price of $8,000, in cash. We debit $8,000 in our cash account against revenue. We also decrease our inventory by $5,000 against cost of goods sold. The difference between revenue and cost is our profit, which will impact our equity. We include $8,000 in our cash flow statement, operating section. We partially pay the invoice related to inventory purchase. We credit cash for $7,000, and we decrease our accounts payable, debiting the same amount. This transaction will be included in the operating section of the cash flow statement. The consolidated balance sheet overview is updated accordingly. Both assets and liabilities went down by $7,000. We sell additional $5,000 of inventory for $15,000. We collect only $6,000 in cash. We debit cash for $6,000, we credit revenue for $15,000. We debit the difference in our asset account for receivable. We credit inventory for $5,000 against cost of goods sold. The profit coming from this transaction is $10,000, revenue minus cost. It will impact our equity. We include $6,000 in our cash flow statement, operating section. We record the annual cost for employees. The total cost was $5,000, only $3,000 were paid in cash. We credit cash for $3,000, we debit salaries for $5,000. The difference is recorded in credit position, in the compensation payable account. The consolidated balance sheet overview is updated accordingly. Assets went down by $3,000, liabilities went up by $2,000, equity went down by $5,000. The cash flow operating section will be updated as well. We receive a payment from our customer for $4,000. The open receivable invoice recorded in a previous transaction will be partially settled. We credit $4,000 in our accounts receivable, and we debit the same amount in our cash account. The cash flow operating section will be updated as well. We borrow $5,000 from a bank in the middle of the fiscal year. The loan will be repaid in 12 months, with one single installment, annual interest 10%. We debit cash for $5,000 against loans payable. The transaction is reported as financing operation in the cash flow statement. No impact to income statement, at least at the moment. We pay $2,000 dividends to shareholders. Even if dividends are not reported in the income statement, they are still part of retained earnings. We need to keep this in mind at the end of the fiscal year. We credit cash for $2,000, we debit the same amount in the account for dividends. Total assets and equity both went down by $2,000. We also update the financing section of the cash flow statement. We are now at the end of the fiscal year. We are requested by accounting and fiscal policies to consider some adjustments to our financials, depreciation calculation for the building, interest calculation for the loan, and tax calculation. All of them have no impact to cash flow. Indeed, depreciation is a non-monetary transaction, while interest and taxes will be paid in the next fiscal year. Depreciation is calculated on annual basis, till the end of the expected useful life, in our case, 10 years. We utilize the straight line method, with an expected disposal value of $0. Take the total purchase value, divide it by 10, our annual depreciation is $3,500. We debit the depreciation expense account against accumulated depreciation. The net book value of the building will be reported as $31,500, purchase price minus accumulated depreciation. We calculate now the interest related to the loan for the last 6 months of the year. First, we divide the annual interest rate by 2 and apply the percentage to the loan value. We credit the balance sheet account called interests payable for $250 against interests expense. Last step, we calculate taxes. Usually, the calculation is done using specific templates, taking into consideration fiscal additions and deductions. In this case, we simply apply the statutory rate, for instance, 35%, to the taxable income. This is our profit before taxes, as per income statement $4,250. We debit tax expense and credit tax payable. Now, we are also able to calculate the profit of the year, which is $2,762.50. We can build now our financial statements, starting from the consolidated balance sheet. Assets and liabilities are reported as either current or non-current. In this exercise, we do not have non-current liabilities. The total retained earnings is $762, given by the profit of the year, minus dividends paid. To build our income statement, we start from revenue and deduct all the costs, expenses, and depreciation. We get our operating income, also known as EBIT, earnings before interests and taxes. We then remove interests and taxes to get our net income. The cash flow statement can be built using the direct or indirect method. The difference regards cash from operations. We calculate the increase or decrease of cash during the year, and we add this value to the closing balance from previous year. In our case, the closing balance was 0, as we just started our activities, and the increase was $5,000. In the indirect method, we calculate the cash from operations, starting from the net income, and adding or removing specific items, as shown in the slide. The final result is exactly the same. That's all for today. Hope you enjoyed the video. Please do not forget to subscribe.